Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. I want to open with just a quick story because last weekend I was in New York with my daughter visiting a school, and we're walking around the campus, the little tour.
This is for college.
For college. And a man walked up to me and said, like, "Hey, are you Matthew
Galgani?"
I'm like, yeah. So it was really funny to see that. It was Jeff from Atlanta, who's somebody who watches the show. He's an IBD subscriber.
Somebody that I've met as
and
well.
He'd met you out in an Atlanta workshop that we had, and I got to meet his very lovely wife and daughter. So that was just a funny coincidence, but
You're
say hi to
famous.
Jeff.
Matt, you're famous. You're famous.
Not quite, but I really appreciate him coming up and saying hi.
Yeah, me too. I love seeing you guys out on the road. I enjoy meeting everybody. It's an incredible pleasure. It really is.
Right. Now this week what we're going to talk about is how to handle stocks that gap up on earnings. Very important subject that you want to get familiar with.
Definitely, absolutely. And come out and see me. I will be in Vegas at the Money Show the second week in May.
All right. You'll find details on that at investors.com/investing show. So now let's take a quick look at the market.
We had a jam-packed week full of news and earnings. We had Mario Draghi, who's the European Central Bank president, in favor of more stimulus. And that puts our Fed chief, Janet Yellen, in a bit of a hot seat. She's going to speak next week, and we'll find out what they have to say about raising rates. And we had some big earnings hits and misses.
We did. And we also had a change in market outlook. On Thursday, the S&P 500's action didn't quite qualify as a distribution day, but it was enough to shift the outlook from confirmed uptrend to uptrend under pressure. And that means it's not clear if this uptrend will continue or if we'll hit more selling and slip into a correction. So you want to proceed with caution, especially if you're holding stocks that are about to report.
Now, stocks that had positive earnings results included Hasbro, who said sales of Disney Princess and Frozen dolls continue to sell well, along with Star Wars The Force Awakens toys. Tractor Supply said riding lawnmowers and fencing materials sold very well in the first quarter, and Skechers beat earnings. But it was not as pretty for some big names that disappointed on earnings, including Microsoft, Starbucks, Alphabet, Mattel, Coca-Cola, Visa, and Netflix. Ouch.
Yes, indeed. Now, for Alphabet, it missed on both the top and bottom lines, and the stock got drilled. It fell over 5% Friday on volume 245% above average. It also fell below its most recent buy point and the 50-day line. So no one knows what will happen next, and it may regroup and hold its ground. But that type of heavy volume selling and a breach of key support often means that more pain is on the way.
Now, Disney had a good week with the new Jungle Book movie raking in $240 million worldwide in its first weekend. Next week, several other big names are due to report.
Now, we'll get the latest numbers from Chipotle Mexican Grill, Apple, PayPal, Facebook, Amazon, and many others. And by the way, I did an article and video on PayPal this week showing how it is dramatically outperforming Visa, Amazon, Android Pay, and others in terms of conversion rate at checkout.
Now, the market hasn't been the easiest, but we still do have a lot of names that are going to report next week, along with the Fed speech from Janet Yellen. So be sure to keep your watch list up to date and be prepared. Also, watch out for more distribution days and see if that happens on any of the indexes.
Right. And as we talked about in last week's episode, make sure that you also keep that earnings season action plan up to date each and every weekend. Today we're going to talk about how to handle stocks that gap up on earnings. And we'll start with a look at some basic strategies and classic examples. And then in the next segment, we'll get into some more recent gap ups and put them in the context of this current market.
So first, what is a buyable gap up, and why should investors pay attention to these breakaway gaps? Well, they may look scary as a stock opens the day powerfully higher than the previous day. That's what causes the gap up in price. And this type of a move usually occurs on strong earnings or a new product, some sort of a new announcement or a regulatory condition.
Now let's start with Priceline as an example. It was forming a cup with handle in August 2010 ahead of earnings. Now this was still relatively early in that new bull cycle that began in 2009, and that's when typically these big gap ups work best. And when Priceline reported August 4th, it soared 21.9%. And that put it well beyond the normal buying range, which is up to 5% above the ideal buy point. But such powerful gaps can still be an opportunity to get in.
Now, volume increased 356%, which shows big institutional buying, and 6.8 million shares were traded. Now, from the gap up, you can see on the weekly chart that price line moved to the week of May the 2nd. This is 2011, 561.88 at the peak, and you got a 139% gain. That is a powerful move off of a strong earnings report with a decent market earlier in a bull market cycle.
Right. Now, keep in mind that it's much easier to have a big gap up in a thinly traded stock since it just doesn't take as much money or as many shares or volume to move the share price. But it requires a lot of heavy buying and institutional money to move a big cap stock like Priceline over 20% in a single day. So while not every gap up in a liquid stock will lead to a longer-term gain, the odds are certainly better when you're dealing with an institutional quality stock like Priceline in a strong bull market.
Okay, Starbucks is another great example of a stock gapping up in price and in a stronger market. As we've said, this can offer investors an incredible chance to buy. Starbucks broke out of a price consolidation early in the bull market cycle that began in March 2009. And this was on strong earnings. Again, that's usually what causes these big gap ups.
Yep.
On July 22nd, Starbucks vaulted 18% on volume that was 458% above average.
Now, if you remember on last week's show, we were talking about making your earnings season action plan ahead of time. That's the key. Do it ahead of time. And that includes deciding if you're going to buy a stock if it does gap up on big volume after reporting. So that means you're going to be ready to act immediately if it does. And it's easiest to spot the gap ups, by the way, on the daily chart. But once you buy, tracking the weekly chart can help you hold. And this really smooths out that daily volatility that basically every stock has, and it helps you see points of support and resistance. Now, Starbucks held the 10-week line, although it did fall below it in the week ended October 30th, 2009. And it had a decent gain by then, which makes it easier to hold, and then it bounced back very quickly.
Now, the daily chart is absolutely necessary when you get into a stock, but as Matt said, we back up to a weekly chart, which is something that IBD chairman and founder Bill O'Neill likes to do. This allows a longer-term perspective. Now, it did go down 6%. It sliced through the 10-week line, but volume was tepid. It was only 25% above average, so that would have made it a little bit easier to hold.
And if you had bought on that gap up, you had a little bit of a cushion.
You had a cushion, yeah. And you also, you're earlier in a bull market cycle. That makes it a little bit easier, too. Now, something to pay attention to is the institutional buying as the stock is breaking out. For the week of the breakout, there were 137 million shares traded. That is a lot of professional buying power.
That is huge. And you would be glad you held on because Starbucks continued to move higher for 2.5 years, forming several bases along the way. Now, of course, you may not have held for that entire run, but buying into that initial gap up provided some very solid gains.
Now, the gap up is something that every investor needs to have in their arsenal. It is a powerful tool, and it works terrifically in strong markets. Now, next up, we'll take a look at some of the more recent examples of a gap up.
Would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
All right, so now that we've looked at some classic examples of gap ups in really nice, strong bull markets, the early stages of a nice bull
Right.
market, let's now take a look at some more recent examples of stocks that gapped up on earnings or other news and how they've performed within the current market environment.
And it's a little bit different.
Very
A
different.
little bit different. So to be clear, gap ups work better in a stronger trending market. And some of the stocks that we looked at in the last segment made huge moves. It was in a
Absolutely.
very strong bull market, so we don't want to just cherry pick those. But there have been some good ones. There have been some
There
good
have
ones
been.
in the recent market. Okay, so let's take a look at one that was really impressive. Let's take a look at Edwards Life Sciences.
Right. Now, Edwards spiked on April 4th, not on earnings, but it was on positive trial results for its Sapien heart valves. And it gapped up to close almost 17% higher for the day. And check out that volume. Trading spiked 336%. And since then, it has added to those gains without coming back to fill the gap, as we say, which sometimes does happen.
Now, Edwards will report their earnings April the 26th, which is next week. Another one we have here, Acuity Brands, gapped up 13% with volume that increased by 186%. Now, volume is one of the key elements to a successful gap up. Typically, and again, we have to say typically, if you have volume higher than 100%, the odds are way better that a stock will hold on to those gains.
Now, Ulta Beauty is another recent example. Following its March 10th earnings report, it gapped up to a 17% gain. And like Amy said, it had the kind of volume that you like to see, a 339% spike in trading. So that's a clear sign of institutional buying. And if you look at the tight trading that followed that, that's a sign that fund managers have been sitting tight and not instantly, very quickly taking profits. Now, of course, we don't know how this is going to play out, but when you buy into a gap up, you need to give the stock some time to build on those gains. So if it doesn't trigger a sell rule and it just trades in that nice tight range for a little while, give it time to climb.
Under Armour gapped up Thursday on a strong earnings report. Shoe sales rocketed. Their Stephen Curry basketball shoes and their Jordan Spieth golf shoes were strong sellers. The stock gapped up 6% on volume that increased 279%.
Now, Citrix Systems, which provides platforms for online meetings and webinars, is another example of how gap ups don't always go as planned, or an example of how they don't always go as planned. The stock bolted higher on Thursday after reporting earnings. But look where it closed. And this is important. It was right at the bottom of the range. So that shows that sellers jumped in right away to take profits. On Friday, it pulled back to fill that gap, as we say. Now, it may hold on and do well, but if you buy into a gap that behaves that way, you want to keep that on a tighter leash.
And Stamps.com is another gap up that didn't work out. Now, it gapped up February 26th, again on earnings, that increased by 118%. That's a triple-digit gain. That looks pretty good. Sales were higher by 67%, and volume shot up 318%. This looks like it should have worked, but that stock ended up rolling over and failing.
And that's why you always have an exit plan. You should cap your losses at no more than 7 to 8%. And of course, you can get out quicker if you see a stock isn't acting right. Now, it wasn't readily obvious what the problem or what the news was that made Stamps.com turn around like that. But at that point, who cares?
It doesn't matter. It
First
doesn't
and
matter.
foremost, you want to protect your money. That's the thing you do first. You can find out the news later.
You find out the news later, absolutely. So investors should definitely pay attention to gap ups. You know, although some of them won't work, a lot of them can lead investors to some stellar gains, especially in a stronger uptrending market. Now, the more compelling the reason for a gap up, whatever that compelling reason is, whether it's a huge earnings beat or a positive drug trial,
Right.
whatever the reason, the stronger the reason, pay attention to those.
Absolutely. And be patient. If the stock is moving sideways after a big gap up, it's
Which
in a tight
happens.
range, it
Which
definitely
happens.
happens. Look at Ulta Beauty. It does that. Now, if that's the case, sit tight. If it's not triggering a sell rule, sit tight and see if it moves on to even bigger gains. Now, quickly before we wrap up, we want to remind you what we talked about last week, and that is that we now have an investing action plan column that comes out each weekend, gets you ready for the week ahead. So you can see the latest of that at investors.com/investingshow.
Okay, see you next week, everybody.